Hello, accounting superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So if you want to learn accounting, you've come to the right place. So today's lesson is about operating leverage, which is really cool. It's really a nifty thing. Now, when it comes to operations and finance, there's two different types of leverage: financial leverage and operating leverage. And today we'll talk about operating leverage. I'll save financial leverage for a later time. All right, so here's how it works. You guys know by now that businesses have variable costs and fixed costs. Now, variable costs are direct labor, direct materials, and as production increases, as sales increases, those variable costs increase. All right, they increase along with sales and production. That's why they call them variable, because they vary with sales and production. Now, businesses also have fixed costs. Fixed costs are things like building depreciation, property taxes, things like that, and they don't increase with production. They do increase, but not with production, and that's what distinguishes them. Now, some businesses have a lot of machines and robots, and oftentimes they can be fixed costs. So here's what's going on. If you have a business and you don't have very much machinery and you have to rely on direct labor to get the work done, well, as sales and production increases, your costs are going to increase too, all right? I mean, it'll probably increase pretty much in lockstep. On the other hand, if you have a lot of robots and machinery and conveyor belts and factory equipment, those kind of costs will stay pretty much the same. And so if you want to get more production out of these robots and machines and conveyor belts, all you got to do is turn the dial up a little bit and make those robots work faster. And you know, the thing about those robots is that they don't need to be paid overtime. They don't need to take extra breaks. They don't call in sick, And so your cost stays pretty much the same. So you get more production, more sales, but not much cost. Now, so when companies are focusing more on fixed costs, we say that they have more operating leverage because their sales and production can increase, but their expenses don't increase. At least they don't increase much. Now, on the other hand, businesses that have a lot of variable costs, as production and sales increase, their costs are going to increase too. So they have low leverage. So here's I've got an example here. I'm going to show you my collection of crowbars. And this crowbar is so darn big, I can't get it in the camera here, the whole thing. Can sort of get it. But this is a monster crowbar. This thing's probably about, 2.5, 3 feet long. It's a giant crowbar. You can do a lot of damage with this thing here. You got to be careful with it. A lot of leverage. So what I'm saying is with this giant crowbar, I can just use a little bit of force and this end down here will really rock and roll. I mean, there's a lot of leverage here. So this would be high operating leverage, to think of it. Now I've got a different crowbar here. This is a little tiny guy. And I use this one actually a lot. Actually, I use this tiny one more than I use the big one because with this tiny one, I don't have as much leverage, which means I don't wreck things or break things as much. So this is a little bit of leverage. This is lots of leverage right here. If you can see it. All right. So businesses are the same way. When you have a lot of fixed costs relative to variable costs, what I mean is you have a lot of robots and that kind of thing. You're relying on machinery to make your product. That means you have a lot of leverage. Okay, a lot of operating leverage. On the other hand, if you're using you're relying on labor, you got a little bit of leverage. All right. So there you go. So anyway, so let's look at the Sunset Sailboat Company. There's something really kind of like magic about this operating leverage. Okay, so here we are. We've got Sunset Sailboat Company. Here's year number one. They have sales of 100,000. They have variable costs of 60,000. They've got a contribution margin of 40 and fixed costs of 30. and a net income of 10. Now, Sunset Sailboat Company is reliant on variable costs more than fixed costs. All right, so there's a little more emphasis on variable costs. All right, but they do have some fixed costs. So they do have some operating leverage. And I put in the percentages here too. Sales are always 100%. Just write down 100%. That's how it is. And variable costs are 60%, and contribution margin is 40%. Here is the magical part. Well, suppose this is how they operated in year one. And they say, you know what? In year two, we want to do better. We want to raise our sales by 10%. We want to raise our sales by 10%. So right now sales are 100,000. If we raise sales 10%, that'd be 110,000, right? So here's the question. And we can answer it really fast. It's incredible how fast we can answer it. So if our sales go up by 10%, how much will our profit go up by? Well, I'll give you the answer. All right. So here's the answer. I'm going to type in 10% because this first line here, if sales increase or decrease next year by 10%, how much will the net income increase by? Here you go. 40%. How in the world did I get that? We're talking about next year. Next year hasn't happened yet. How do we know that? Well, what if sales were to increase by 15%? How much would our net income increase by? 15%. Wow, it increased by 60%. Holy smokes. How did that happen? How can that be figured out? Or what if our sales were to boom and we would increase sales by 30%? Man, our profit would increase by 120%. How in the world can this be figured out? Well, through operating leverage. We can measure operating leverage, and I'm going to show you how to do it, okay? So let me set this back to 0. There we go. So in other words, if sales increase by 0, our net income won't increase either, all right? So here's how it is done. It's called the degree of operating leverage. And here's the formula. The formula is contribution margin divided by net income. So that's the degree of operating leverage. So all you do is you take your contribution margin divided by net income and boom, that's the degree of operating leverage. And in this case, it'd be 4 because 40,000 divided by 10,000 is 4. All right. Okay. So what does this mean? How do you interpret this? How do you read it? Okay, so here you go. For a given percentage change in sales, what will be the percentage change in profit? That's what this degree of operating leverage means. And if you're kind of lost here already, well, operating leverage is the relationship between variable costs and fixed costs. Fixed costs, when you have a lot of fixed costs, it tends to be like the big crowbar, a lot of leverage, do a lot of damage with this thing. And when you have high variable costs relative to fixed costs, that's little leverage, all right? Which is okay in a lot of situations. Like this little crowbar, like I mentioned, I use this one more than the big one. All righty, so let's go down and see how this is done here. So there you go. Formula one more time, contribution margin divided by net income. So I'm going to split the screen. How do we figure this out? Well, all we do is we say, well, what's the contribution margin? The contribution margin is right here. I'll highlight it so it stands out for you. Here we go. So you drop it into place, just put it right down here, 40,000. And then you say, what's the net income right now? The net income is 10,000. I'll put that right here, 10,000. And by the way, while I'm thinking of it, if you're wondering why fixed costs is in bright red here, in 30,000 bright red. The reason why I put it in bright red is because it's the key to operating leverage. All right, the higher the fixed costs, the more operating leverage we say we have, and that's because you're relying on more machinery, more equipment, but the costs are fixed; they don't change. So to find the degree of operating leverage, all you do is divide. So 40,000 divided by 10 is the number 4. Boom, there you go. So that's how we do this. So here's how you do this. is if sales increase by 10%, the net income will increase by 40%. How did I do that? Well, 10% times 4 is 40%. That's all there is to it. Nothing more to it. It's just that easy. So let's see if that's really true. Let's see if that really works. Well, here's what we'll do. We'll fill in the numbers for year 2. So if sales increase by 110%, or I'm sorry, if sales increase by 10%, we will have sales of 110,000. And of course, we put that as 100%. Now, the relationship of variable costs and contribution margin to sales hasn't changed a bit. So this will still be 60%. This will still be 40%. So 110,000 times 60%, we'll get our variable cost, 66,000. 110,000 times 40%, we will get 44,000. And another way to figure it out is 110 minus 66 is 44, all right? Now, fixed costs, they're going to stay the same. I'll put this in the red print here just so it's consistent. So fixed costs, still going to stay 30,000. Our net income is going to be 44 minus 30. So here we go, put it in black print. There we are, 14%. So let's see if this is true. Our sales increased by 10%, and our net income increased by 40%. Look at that. You know, net income increased by 4,000, so that means we've got, 4,000. That's a 40% increase over 10,000. All right, well, so far so good. Now the operating leverage is 4. Now, this is something that's going to be kind of crazy. Our operating leverage is going to change. Why is it going to change? Because our relationship between variable costs and fixed costs have changed also. Now, I'm going to let you guess here that our variable costs went up from 60 to 66, and our fixed costs stayed the same. So in other words, the leverage, fixed costs are really where the leverage is. So fixed costs stayed the same, but variable costs got bigger. So you know what? We kind of went from a big crowbar to a smaller crowbar because we're relying on more variable costs. The amount of variable costs went up in relation to the fixed costs. So our crowbar, got tinier, less leverage. How do we figure out the degree of operating leverage? All right, well, let's do it. The contribution margin is 44,000. So let's drop that into place. There we go. And our net income here is 14,000. So let's drop that into place. And so if we do a little division, 44,000 divided by 14,000, our degree of operating leverage will be 3.1. So folks, we went from a big crowbar down to a little smaller crowbar, all right, because we're relying more on variable costs. So, all right, so let's see here. So what if we're done with year 2? We're done with year 2, and we think, oh, sales are going great. Sales are going to increase next year by, 20%. Okay, I'm just throwing out 20%. You can use any number you want. So sales are going to increase by 20%. How much is our profit going to increase by? Well, here's the secret. This is what it is. It's 20% times 3.1. So if you do the math, that's what, about 60 something percent? 20% times 3.1, and you'll have the amount of your profit increase. 63%. Look at that. Let's see if that's true. Let's see if it works out. So in year, going from year 2 to year 3, so sales are increasing by 20%. So what would the sales be? They'd be 132,000, and that's correct, folks. I checked this spreadsheet thoroughly before I made this video here. Now, sales are always 100%, right? Always. Never fails. Just write 100%. And you know what? The relationship of variable costs and contribution margin in relation to sales is not going to change a bit. All right. So 132,000 times 60%, and we will have our variable costs. And let's see here. Contribution margin, 132,000 times 40%. There we go. And of course, we could have just subtracted, 132 minus 79.2, and boom, we would have had it, So we could subtract, multiply, whatever you want to do. Now, fixed costs, they are fixed. They're not changing. There we go. So, and the profit is going to be, 52,800 minus 30, and our profit will be 22,800. So here's how you could check this, and I already checked it, so I know it's right. Is that 14,000? If we were to increase 14,000 by 63%, we would get 22,800. It actually does work. You can do the math yourself if you like. All right, so let's see what the degree of operating leverage is now. Now I'm going to give you a clue here, is that our variable costs went from 66,000 to 79,200, and our fixed cost remained the same. In other words, we're getting more reliant on variable costs. So what that means is we're going from a big crowbar down to a smaller crowbar, okay? So it's how it works, is that the leverage really takes place in the fixed cost. That's where the leverage is. And our leverage in relation to our variable costs is just getting smaller. Look at that, 79.2 to 30. It's smaller than it was before. So what's going to happen to our degree of operating leverage? Is it going to get larger or smaller? Well, leverage means, you're using a little bit of force to do a lot of work, but it looks like we're relying less on the leverage. Okay, so contribution margin is 52,800 right there. So let's drop it into place. There you go. And let's see here. Net income is 22,800. And you do a little division, 52.8 divided by 22.8. There's our degree of operating leverage. And look at that, it's getting smaller. It's getting smaller. So here's a question for you guys. How would I figure this out? If in the third year, we think sales are going to increase by 5%. Sales are going to increase by 5% in year 3, or I'm sorry, in year 4. Let's say that year 3 is done, it's complete, and we think sales in year 4 is going to increase by 5%. Now, I don't have year 4 listed here because I had to stop someplace here, but so it's going to increase by 5%. Can you tell me by how much net income will increase? It's really easy. All you do is go 5% times 2.3 and bingo, you're done. And you could prove it. You could work it out and see if it works. And it really does work. So there you go, guys. So that is a introduction here to operating leverage. And guys, there's in business, there's two kinds of leverage. There's operating leverage, which now you know a little bit about, and there's financial leverage. They're both kind of the same principle. It's interesting. There's a lot of similarities, but we'll cover financial leverage at another time. So, guys, I've got a webpage called accountingsuperstars.com. And I've got all my videos listed on there by topic. So if you're looking for a certain topic, it might be a little easier to go to accountingsuperstars.com and find the video you're looking for. Also, if you like this video, hit the like button, subscribe button, and that way I'll know to make more videos for you. So until next time, over and out.